Hey everyone, Anthony Venuto here with InTouch Mortgage Solutions. It's Friday, Finance Fridays, and thank you again for tuning in for another episode. On this episode, we're going to be talking a little bit about the Bank of Canada. Will they increase rates? Will they cut rates? Or will they keep rates the same for 2023? And what is happening in the housing market? What is trending right now? Stay tuned, you don't want to miss this. Over the past several weeks, we've been working with a lot of our first-time home buyers, a lot of younger buyers, even a lot of clients that are approaching mortgage renewals. And we've been having this conversation, and a lot of the times these individuals and couples are bringing up the question that I would take an opportunity right now to address is, and might be on a lot of our viewers' minds, is what will happen with the Bank of Canada? Will they be increasing policy rate in 2023? Will they hold steady for a long duration through 2023? Or will we see the Bank of Canada actually cut rates by the end of 2023? Now, although it's very difficult to predict what the Bank of Canada will do by the end of 2023, I think with the anecdotal evidence and obviously what we're seeing as observations at the current moment, a rate cut at this particular point in time is off the table. And not just because the Bank of Canada has signaled and said, hey, we're not even thinking about cutting rates. It's more along the lines of the data that is rolling out, and something we'll get into in this video. But what I want to do is just basically go over a few key points on why I think the Bank of Canada is going to avoid cutting rates, and most importantly, what will happen, will they increase or hold steady? So over the last little while, since the beginning of January, we heard first from Governor Tiff Macklem and the Deputy Governor. Obviously, we heard that they were increasing policy rate 0.25% and that they were going to hit the pause button. Now, they've made it very clear, they've reiterated several times that the Bank of Canada is going to pause to monitor the current state of the Canadian economy and ensure that their existing monetary tightening, the 8 consecutive increases that we've seen, are actually starting to unwind in the economy. So as long as all their data points continue to align, then they will continue to potentially hold. Now, what would happen for them to have to increase policy rate? Well, obviously, this is something that has come to the limelight just over the last few weeks. So a few things, a few indicators. First and foremost is the Bank of Canada, and the reason why we can have this conversation with a little more degree of certainty is in January, the Bank of Canada also released their report that indicates and showcases how not only how Governor Tiff Macklem and the Governing Council and the Deputy Governors arrive at their conclusions on how to approach monetary policy, but it gives us some insight on the data points that they're looking at. So this was something that was very interesting. For the first time in history that we've had a central bank come out with basically a report that shows the average Canadian how they're going to be arriving at these conclusions. Now, with that being said, what has changed since early January? Obviously, a few things, major things in my opinion. One being the labor data, the labor force has increased. It has shown resilience in job creation. We've seen 150,000 new jobs come to the market in January. Now, over the past several months, we have definitely seen a major run up in these in employment numbers. In job creations, which have definitely have a negative effect on the Bank of Canada's decision. Now, let's take a look at those numbers. At 150,000 new jobs, they were talking about 15,000 new jobs. We're at 150,000. Even if the Bank of Canada and Stats Canada got this wrong, which they have in the past, there has been the capacity for them to go back and do revisions or alter those numbers to more correct numbers. Then the fact is that there's still all these jobs being put into the labor market. And the Bank of Canada doesn't like it. And the reason why they don't like it is because if we start to see the unemployment rate stay the same at its historic lows or even come down, well, that's definitely a negative signal, because more people working means more people earning money. More people earning money means more inflation or more spending in the market. Also, if you have more jobs readily available, more people are working, which is obviously going to contribute to inflationary pressures. This is what the Bank of Canada wants. Now, although this is a complete head scratcher to me and probably to you, our viewers, this is what the Bank of Canada has signaled several times over the past several rate announcements and all these wonderful conferences that they hold. So, what does this mean? Well, let's look at the deeper into these job numbers. Well, out of the 150,000 or some odd jobs, a lot of these jobs are full-time position jobs. And a lot of these jobs are also not going to existing citizens, they're going to new to Canada individuals. Maybe you have a work permit, maybe you have a temporary visa, maybe you have your permanent residency card. So a lot of these jobs are being filled by the higher immigration policy that has been implemented by the federal government. And this begs a major question. So as we have more people competing in the tight labor market, in the sense that, there's a lot of jobs available. For example, we had a client who lost their job, within a few weeks was able to locate another job. During a tight labor market, that's possible. But in a labor market that has a lot of slack, that individual might not be able to find a job that easily, because these companies don't necessarily want to hire. And the companies that are hiring and the companies that have these employees that are maybe well trained, well skilled, have tenure, well, they're going to have to pay these employees more. And the increase in the wages is gone up, I think it was at 4.8% just a little while ago, and now it's come down to around 4.5%, which is good if you're on the receiving end of these wages, because that means you make more money, which means you have now more capacity to spend. And this is a problem, once again, for the Bank of Canada. So obviously this is a major problem. But my question is the Bank of Canada, or to the Bank of Canada and the governing council, would be sort of looking at these jobs. How many of these full-time jobs are individuals that were previously working, maybe on maternity leave, returning back, maybe individuals who were on a short-term disability or on an illness leave and coming back to work? How many of these individuals might have been part-time, now being taken on full-time? And more importantly, are these individuals their first or second or third job? Because as inflation continues to still run hot in Canada, many individuals might be finding themselves in a position where they need to find another job in order to make ends meet. Sadly enough, this is a problem for the Bank of Canada. So not only does the Bank of Canada want you to lose your job, they want you to suffer for it. And I think that's a little bit of a problem here in Canada. And obviously, let me know in the comment section below what you think about that. Now, the other thing that the Bank of Canada is paying very close attention to is the housing demand. What is happening in housing? Well, over the past, since 2022 March, we started to see home prices come off as interest rates went up. And as a result of interest rates rising, well, the direct correlation between interest rates and home prices start to soften. So as interest rates come down, so do home prices go up, for that matter, right? And if interest rates go up, well, less people can qualify, less people want to take on these massive mortgages on these really expensive homes, so home prices will tend to come off. And we've seen this happen throughout the course of 2022 into ready 2023. But right now, because of what happened in January, my thoughts are that because the Bank of Canada somewhat signaled to the market, or to home owners or home buyers and anyone in the market, that, hey, we're hitting this pause button, a lot of misinterpretation is happening. Maybe a lot of first-time home buyers might say, hey, now is the time to engage in the market. Home prices are down, so we can purchase at a discount. And let's go get a pre-approval, because fixed-rate mortgages were on their descent down. And now might be a good time to get in there when we can. Also, from the client conversations that we've had, is all these people, this pent-up demand that they're talking about in the media, although it is somewhat true, from the conversation we're having on the street level, there are many individuals who put those buying decisions on hold back in 2022, waited to see what would happen, are waiting for this point in time where interest rates on fixed mortgages have come down a little bit, and there's some stability with what the Bank of Canada is doing. So this is almost like a perfect storm in some way. Now, obviously, whether you agree or disagree with it, I'm not the one going out there to purchase a home. We are hearing this from our clients that are coming to us saying, Anth, we want to get pre-approved. So obviously the difference now is that buyers have more time. There might be a lack of inventory. They might have to be patient. Obviously, we need to see what happens with distress sales, power of sales, and individuals that just can't hold on much longer with these higher interest rates, because there is a very important correlation between what interest rates are doing, whether they be variable, which are hovering in around the 6% mark, and fixed that are just in and around the 5% mark, which have recently gone up as a result of the labor numbers. And a lot of this data that's rolling out has a lot to do with the sentiment in the bond market. So just to take a step back, the bond market is a good barometer of fixed rate mortgages. And the bond market itself can price in, or prices in recessions, prices in dips. It takes a look at the entire picture. Now, although the Bank of Canada does influence a lot of the decisions on investors in bond markets, those prices, those yields impact fixed rate mortgages. And if they see a little bit of relief in the future, in the, let's say, 5-year or plus range, well, those yields might come off. And I mean, what we saw happening over the last little while was we saw bond prices come off. They've now skyrocketed back up, ripped higher to around 3.3%. And because of this, right, fixed rate mortgages are going to move. They're very fluid. And that is a major problem for Canadians who are approaching renewal. If you're in a 3% or 2.5% mortgage renewing into a 5% mortgage, well, that is a huge payment shock. So how long can Canadians, for those who are heavily indebted, potentially hold on for? Now, obviously, we're seeing this translate through the rental market and investors. And yes, the Bank of Canada, in a recent publication by Better Dwelling, talked about how the Bank of Canada fueled this excess demand by dropping interest rates and, yes, creating quantitative easing at the behest of, I believe, the federal government. So there's a lot of conversation here there's a lot of banter back and forth. But more importantly, as I said, the housing market, if we start to see these multiple offers equate to higher home prices or coming off their lows, and we start to see more transactional data, the Bank of Canada will perceive this potentially as a risk to inflation, a risk to the stability of the Canadian housing market, and therefore could push to higher policy rates in order to crush the demand of those buyers. Now, the other thing too is if we see home prices, now this is the counter argument, if we tend to see home prices crash or fall off a cliff, maybe surpassing what their predictions are right now, depending on what news sources you're looking at, well, the Bank of Canada potentially might step in as well, because although their mandate is to keep inflation at 2%, they also have a duty to ensure that the financial system is operable and that we have liquidity, that we have a certain balance in the market, and there has to be this balancing act. This is why we always say, be careful what you wish for. Now, ultimately, in the end, we have other components such as GDP. We have what is happening globally in Europe with Russia and Ukraine. And more importantly, something that is starting to gain a little bit more traction is obviously what is happening with China and China reopening. As that market reopens, there's going to be a lot of pressures on global commodities, and that will impact what happens here in Canada and in the US and across the world. So you see that there is a different set of components. Now, obviously, there's probably a lot more. If you read the report, there's definitely several factors, but for us, for the sake of this video, we're talking about employment and we're talking about housing. We're talking about the debt load here in Canada. Now, just to go back to the debt load, one thing I wanted to enter that came into my mind was that when we have this conversation about consumer debt load in Canada, and the US and Jerome Powell basically indicating to the markets that they're able to increase policy rate above and beyond the 5% mark, well, there is a major distinction between the US and Canada. Canada, unlike the US, did not experiencing a major deleveraging during the great financial crisis. In the US, many of us saw the Big Short. You noticed, hey, bankruptcies, home foreclosures, and a lot of these investment banks going belly up. That is completely different than what happened in Canada, as we felt it here in Canada maybe for a very short duration. I would argue 8 to 12 months. After that, we continually saw a run up in home prices and consumer spending, which means the debt load here in Canada is much greater than that of the US. So the amount of increases that the US has to do in order to have the same impact or pressure the Bank of Canada has to do less to get to that same pressure point. And let us sit back and watch as the Bank of Canada waits to see how their monetary policy over those 8 increases actually plays out for Canadians. So we'll leave the video here. I want to know your thoughts. If the Bank of Canada's mandate is to keep inflation at 2%, and they want to see employment drop, they want to see these numbers drop, they want to see unemployment rise, and the federal government wants to see immigration, which is inflationary in nature, how are these two polar headwinds going to collide, and how will the Bank of Canada respond? Will the Bank of Canada change their positioning, or will the federal government, have to change their positioning? I really want to know from our viewers what you think about that. But until next week, thank you again for watching. Thanks for clicking, and have a great Friday. We'll see you next week.